Safety with growth is something you often hear in my videos, other people's videos around how you should invest in retirement. Avoiding the risk, you don't have the time, to recover like you did when you were younger. In retirement, especially like the first 5 to 10 years, you really need your assets not to drop by 50%, 30%. You really need some stability there. If you get good returns in the first part of your retirement, you can get a little more risky after you get past what they call sequence of return risk. I think you know what that means. So here are 10 investments that I avoid in retirement. Not saying you should. I'm just telling my story. I've been retired 6 years now. I'm 61 years old as of a week ago. At the end, I'm going to give a short list of what I do invest in. So let's jump right into it. Number 1, high risk individual stocks. I own no individual stocks. Something I should have said earlier is if you won the game, stop playing. That's what retirement's about. I'm not looking for tremendous growth. I'm trying to resist fear of missing out. I'm not trying to get market returns. I'm trying to get market returns in my bucket 2 growth engine, but not in total. I have my bucket 1 safety. Okay. So individual stocks, if you want to buy 5%, 10%, do you. I own 0 individual stocks. It's just a philosophy. It's lack of diversification. It's a temptation. If those do well, I buy Apple stock and it doubles. I may want to get excited about that and make bad long-term decisions. So I'm just a sloth investor. Don't do anything sudden, no sudden movements, just moving forward. The volatility can be very traumatic. If your portfolio is down 30, 40, 50% because of individual stocks, what will that do to your youth of your early retirement years, your first 10 years, 15 years when you're young and healthy, able to do those go-go things, right? So no individual stocks for me. Maybe in the future, but not right now. Number 2, highly leveraged investments. And let me say, I get asked these questions. That's why these videos come up. These are investments like where you get triple leverage on the S&P 500. So if it goes up, it'll go up. This particular investment goes up 3x. If it goes up 1x, it'll go 3. But hey, guess what? If it goes down, it'll go down 3x. All those leveraged ETFs, all those funds, all those shiny objects, I just stay away from. Number 3 is what I call speculative assets, cryptocurrency. It's speculative because it doesn't produce anything. It's just there. I understand people go to it because it can't be manipulated like the US dollar or any other currency. But it's speculative and it's got high highs and it's got low lows and it's got a lot of drama with it. I'm out. Okay. That's not my retirement journey that I want to be on. Safety with growth. And I'm saying safety first for a reason. Number 4, illiquid investments or assets, private equity. I'm not in private equity. Those are, funds that you secure in for years and it's hard to get out of them and they could dramatically pay off. They have high fees and they could not pay off. So I just stay out of them. Number 5, long-term bonds. Okay. All I'll say is remember 2022. People lost 15%. I know several people lost 15% in their safe assets because they had a lot of bonds and bond funds, in particular long-term bond funds that just got massacred. When interest rates go up, long-term bonds fall through the floor. I just stay away from it. I do have short-term and medium-term bond funds. I think that's okay. It gives me stability. I owned no bond funds until the beginning of 2024 because they were just paying dirt. I I just had money in a money market fund, CDs, treasuries, but I've been in a bond fund for a year and a half or so now. I'm not sure that's my long-term play. I do not like bonds, but it's not a bad deal right now. I expect interest rates to go down from where they are. But long-term bond, no. Number 6, this will be controversial. Rental properties. I know a lot of people and a lot of YouTube guys that we talk regularly that they've gotten wealthy based on real estate. Not for me. It's a good income source, but the property management, the tenant management, just the interaction that I would need as a retired person with real estate, I don't want any part of it. Now, you could have a great managed one where somebody takes care of all the tenants, they take care of all the repairs, but that eats into the profits quite a bit. I don't want that headache at all. Then that's a personal decision. If I was going back to age 25, maybe I would get into rental properties. I probably would have, and get 6, 8, 10 of them, maybe retire at 40 years old and manage those. I like doing handyman work around the house, but not at 61. I'm in a different journey than that. Give me comments if you think I'm crazy there on real estate. Number 7, another emotional one. I'm avoiding annuities. I don't have an annuity. I'm avoiding it. I don't think they're a terrible product, but they're an insurance product and they are designed to take risk off the table for you at a fee. Okay. So I manage my money differently. I have buckets. My bucket 1 is my safety. That's my risk management fee. And then I have, my bucket 2 is the growth engine. So that's how I'm managing risk. Annuities can be great if you're just very sensitive to changes in the stock market, the bond market, and you just want your base expenses covered with an annuity. I don't think it's a bad thing. Read the fine print. They're very complex. And I think it's Dave Ramsey that says annuities aren't bought, they're sold, meaning that a salesman has to sell them to you and convince you they're the right thing. You don't actively go and get an annuity. But again, I don't think they're bad. Maybe, someday I'll own one. Now, everybody kind of owns one in the form of Social Security, which I'm delighted to have. Anyway, I don't own any right now, and just be very careful. I think for some people, maybe 30, 40% of people, this is a good idea. Not for me. Number 8, collectibles. I get 2 emails a day on, hey, Joe, why don't you invest in art? But in the same category as coins, cars, all these kind of things. Art has gone up, 12% a year for the last 20 years. Hey, it's not my game. I don't understand art. I'm just avoiding it. It's a subjective value. I believe in investing in businesses that make products. Okay. That's just me. You do you, but it's amazing how hard art is being pushed on the retirement community. You're probably getting those emails and text messages as well. Number 9, startups and business ventures. I get approached occasionally about these, investing in a business with family or friends or a stranger even. Could end up in total loss. It's just, they could be huge gains. That's not the game I'm in. I'm in removing drama, add safety, and get some growth. Okay? Won the game, stop playing. These can sound interesting, but they can be catastrophic if you get more than like 5 or 10% invested in one of these. But again, even if you're investing 10%, if that pays off 200%, 300%, you're more likely to get excited about that, think you've got some skills in identifying the right business. All of a sudden, you got 50% of your net worth is in business ventures. Then, the economy turns, legislation changes, and now you're out. It's just too risky for me, too much drama, but can be a lot of excitement, and that tells me not to invest there. And number 10, timeshares. Timeshares, difficult to sell, poor resale value when you're going there. Maintenance fees and assessments can be huge. I know one person that is delighted with their timeshare, had it for about 20 years. And I know about 20 people that hate their timeshares. My wife and I have gone to a couple timeshare establishments, I guess, and the high pressure sales, it leaves a bad taste in my mouth. I want no part of it. So timeshares is number 10. So there's my 10 things. Okay, Joe, where do you invest? This is much shorter. Number 1, mutual and index funds. Quite frankly, I have most of my money in American funds, mutual funds, which is a managed fund. I've talked about that on other videos. They've been doing extremely well through the 2000 to 2013 time period. Did extremely well, a lot better than index funds. But I digress. Of those, that's where 80% of my money is, in these kind of funds. 17% of that of the equities are in international. I own a bond fund which has 10% in it, roughly 10% of my net worth. I have a money market fund with roughly 10% of my net worth in, so that's an 80-20 portfolio. And then I have about 2.5 to 3 months cash. Okay, and this is in a high yield savings account and my checking account, just kind of what we're spending money out of. And every month I look at, I transfer money to maintain a minimum balance from my money market fund, transfers in a day. It's a Fidelity account, transfers over, maintain a cash level so we can spend out of. So that's where my money's invested, and the 10 assets I avoid investing in. Let me know, 1, if I'm crazy. Number 2, if you got an asset that you said, hey, Joe, you're wrong on this one, get a discussion going in the comments. Man, there's gold in there. If you're not reading my comments that are in my videos, rather, the comments you make in my videos, there's gold there. And I'm willing to say I'm wrong, and I need to investigate that some more. So please let me know where I'm wrong, where you think is a great investment idea. Do you think I'm being too conservative? Do you think I'm being too safe? Let me know. It's Joe out.